All right, so bank reconciliation, this is support material for it. Okay, so again, just to recap one or two things that you should be familiar with. So we just spoke about a journal. Remember, what is a journal? It's just a book to record what? Types of transactions, yes. Okay, so different types of transactions will be recorded in a specific journal. A general journal will be general, meaning everything will go to that particular account. Okay, so you can get specialized journals. Okay, you can get a journal that focuses on receipts, and you can get a journal that will focus on payments. Okay, it's just grouping a specific type of transaction. Okay, so when I receive money, it doesn't matter where it came from, what's going to happen to bank? It's going to go up. Okay, so bank will be positively affected. We know what bank is, it's an asset. Okay, so assets increase on the debit. Okay, and that's key in terms of the effects. Right, because obviously later on when you do cash flow, you need to look for this. Bank. Okay, so you're trying to find the movement in terms of positive or negative. Right, and that's cash flow. Okay, so the basics are still applied later. Okay, you need to know what the effect is, all right, in terms of the transaction that's affecting which accounts. Okay, so other accounts, what other accounts could you get?
Payable. No, not payable. No. What am I saying? Increase.
So bank would go up. Debit. What could possible credits be?
Oh no, I just can't think. Somebody's paid you.
Someone has paid you. Who would pay you?
A receivable.
Yes, a debtor. Okay, or a receivable. Okay, what else? What else could be credited?
Receivable. What was that? Expenses.
No.
If you paid off an expense, no?
If you pay off an expense, then you've got this.
Oh, incomes. What am I saying? I mean incomes.
Okay. Yeah, so give me some income.
Sales income, rent income.
Sales, rent, good. So interest, all of that. Yeah. Right, so all of those accounts would be credited. Why? They're either assets that are going down in terms of debtors or sales going up. Okay, so with the cash flow, you mentioned cash flow earlier. So just to mention that here, what other account could be affected? Capital.
Oh, yeah.
Okay, capital can be given to the business by the owner.
Yeah.
Right, that'll be a credit.
Yeah.
What type of cash flow is that? Operating, financing, or investing?
Not sure.
It'll be operating, finance, or investing. Operations? Is capital part of operations?
No.
No, is capital financing?
Yeah. Yeah.
Why?
Because you're getting money into
because you're receiving capital from the owner.
Okay.
Okay, there's 3 sections.
Okay.
Right, so something like that would be applicable to cash flow. Okay, debtors. If debtors pay you, what is that? Operating, finance, or investing?
No, is it operating?
It's operating, okay, because you're running a business and you'll have outstanding debtors.
Oh, okay.
Okay, and then if it's investing, what would I credit if it's investing? We looked at it yesterday. PPE. What happens to PPE? I can sell it. If I sell PPE, what does that do to the asset?
Decreases.
It decreases the asset. So the asset will go down. How do you decrease PPE? You credit it.
Okay.
Okay, what is that? Operating, finance, or investing?
Operating, no?
That's investing, okay, because relating to long-term assets.
Oh, okay.
Okay, so property, plant, and equipment could be affected, and that would go to a cash receipts journal. Right, so there are so many different transactions that could go here.
Yeah.
Right, you'd credit whatever.
Okay.
Right, and then the same thing with the payment. You would credit bank, why?
Because you're losing money.
You're decreasing your cash.
Yeah.
Okay, an asset is decreasing, it must decrease on the credit.
Yeah.
Right, then other accounts that will be affected, what could they be?
That'd be like an expense or...
An expense could be one, any expense, what else?
If you buy inventory.
If you buy inventory.
Or anything asset really.
Alright, or any asset that you're purchasing, PPE.
Yeah.
Alright, so again, inflow, outflow here. If I buy PPE.
Inflow.
No. Inflow, outflow in terms of cash.
Outflow.
Outflow. Okay, if you're buying cash, if you're paying cash to buy PPE,
you're losing cash.
Your bank is being negatively affected.
Yeah.
Okay, so this is bank recon, but it also relates to your cash flow.
Okay.
Okay, because you know what happens when accounts are being affected.
Yeah.
Something is debited, something is credited. Why? Because an element will either be increasing or decreasing.
Okay.
Okay.
Yeah.
Alright, so how does this affect the bank recon? It's this, the bank account. Okay, what is this? This is a general ledger account. Okay, so general ledger accounts have a debit side and a credit side. Okay, so what would receipts do to the bank?
Receipts would increase, no?
So where do you increase a bank account?
Debit.
On the debit. Okay, and that's how you would reference it in terms of the T account, the general ledger. Okay, so total receipts would go up on the debit side. Okay, total payments would go up on the
Credit side.
credit side. Okay, why? Because a credit for bank would decrease the account.
Yeah.
Right, so if I have more payments, I'll have less cash. Okay, and then balancing, to balance the account, right, you would carry down a balance and bring down a balance. Okay, after summing up the debits and credits. Right, so that's recap that you need to know before you do a bank recon. Okay, we need to then recap one or two things in terms of non-current to current. What's the difference?
Non-current is longer than 12 months, right?
Yes, greater than 12 months or less than 12 months.
Yeah.
Why is that important?
Oh.
Because of disclosure.
Okay.
Okay, so remember, you're going to be drawing up statements.
Yeah.
Alright, statement of financial position will be broken up into non-current and current. Why? You get long-term and short-term assets and liabilities. What am I looking at here? Assets. Okay, so if I'm looking at bank, if bank is an asset, what balance will it have?
Debit.
A debit balance. Okay, and if bank has a debit balance, it will be seen as a current asset.
Yeah.
Right, and if it's a liability, what do we call bank as a liability?
Bank overdraft.
Correct. Okay, why? It's a liability, and liabilities have a credit balance.
Yeah.
And if it's a credit balance, it will be a short-term liability because the bank overdraft would be seen as a short-term obligation.
Yeah.
Okay. On the next slide, you've got a note about the importance of monitoring and managing cash. Why must businesses do that?
Because they need to know where their money is going to.
Okay, cash flow is what actually determines if a business will fail or not. Okay, this is more the finance. Okay, so in management accounting, in finance, in those subjects, you look more at the decision making relating to cash flow rather than profit. Yeah. Profit means nothing to a financial manager. Why? It's easy to manipulate or change the profit.
Yeah.
It's difficult to manipulate or change the cash. Okay, and that's why cash flow is key, and that's why you have a separate statement for it. Okay, so cash flow in this particular accounting module is the closest you'll get to finance. Okay, finance doesn't look at debits and credits. They don't care about debits and credits. They just care about decision making in terms of what adds value or what reduces value. Okay, from an accounting point of view, they want debits and credits, and that's why they want you to draw up T accounts. Okay, because we're looking at cash flow. Okay, so you might not have done T accounts for this section, right? You might have done T accounts later on. Okay, but T accounts, as much as you said it isn't going to be examined, right, it's great for workings. Okay, and workings are examinable in terms of marks being allocated to it. Okay, so even though you're not going to have to specifically draw up general ledger accounts, it could be part of a working for a longer question. Okay, you can't do a cash flow if you can't draw up a T account. Okay. Right, so internal control over cash is key. Okay, that's theory. Theory won't be tested in this module. It should be tested in others. So auditing is the main module where they look at systems. Okay, so then they'll test you on, so what must be in place in order to have good internal control over cash. Okay, that's a separate module. Right, we're focusing on this. There's the key. The bank reconciliation. What is a bank recon? It's confirming that internal records are the same as your external records. Okay, because remember we said how many people on a transaction? How many parties? Two. Okay, so in this particular application, how many parties do you have? Two. Who do we have?
The bank and the company.
The bank and the business, exactly. Okay, so internal records would be the business, external records would be the bank. Okay, what internal record do we have? We've got bank. What is bank? It's the general ledger account. Okay, and the bank statement is whose books?
The banks.
The banks. Okay, external. Alright, so you've got two things. General ledger bank, okay, and bank statement, which is the external party. Okay, so there's the note. The business has the internal records being the general ledger. The bank, which is the external party, will have what? The statement. Right, so if I have a favorable bank balance as a business, What balance will you see on the business's account?
Debit.
A debit. Why? That's internal. Okay, so if you've got a favorable bank balance on your account in your books, what will the bank have in their books?
Credit, no?
Yes, why?
Don't they owe you the money or something?
Because you've actually given the bank those funds.
Yeah.
The bank is entitled to pay you back those funds that you've deposited. Okay, so that's the first one. Asset, favorable, debit. Liability, unfavorable, credit.
Yeah.
Okay, so we're looking at this in terms of perspective.
Okay.
Alright, so whose perspective? The business versus the bank. Okay, we need to look at both. Why? We need to determine who's right and who's wrong. Okay, if our books are right, do we need to change anything?
No.
No. If the bank's books are right, do we need to change anything?
No. Yeah, of course.
We do.
Yeah.
Okay, so if the bank's books are right and ours isn't, we need to change something.
Yeah.
Okay, because can we change our books?
Yeah.
Can we change the bank's?
No.
No. Right, so then what happens if we have a liability? So if the business has an unfavorable bank balance, what will I have?
Then you'd have a credit on the business side.
And?
The bank would, you would owe the bank money, right?
So the bank would have what?
Debit balance.
The bank would have an asset.
Yeah.
Okay, and that's how the bank recon works. Okay, you've got a debit on one side, you've got a credit on the other side. You've got a credit on the one side, you've got a debit on the other side.
Yeah.
Okay, so the example that I gave you yesterday was looking at question 1, which was a positive or favorable bank balance. Okay, the other example has a different bank balance. Okay, but the question is very similar in terms of application. Okay, so I'll run through the first one with you just to give you an idea of how to approach a question like this. Okay, it depends. They could give you the actual documents or they could give you wording. So they could tell you, this is what's different. Okay, they can tell you, the bank has this in their books, we have this in our books. Right, then you would have to just interpret that.
This is how they've always asked it when we've had it in a test before.
Yeah, it's probably been wording.
Find it. 369.
Yeah, most institutions will test it in Word format. Yeah.
This is how they've done it. I'll go to the end of the chapter.
Yeah, look at one of the examples.
Yeah, there was an example. Another example. Here's an example, another one. So this is how it starts.
Okay, see, they express it in words. Oh no, see, this is showing you how to do it. See, they are doing the ticking. Okay, we're going to do ticking on the example as well.
And then here's the solution.
Yeah, see, we're going to do ticking as well. But I want to see a test type of example.
These are test. We haven't got back the papers.
Okay, but you've been tested on Bank Recon before.
Yeah, once I think.
Okay, then you probably won't get tested on it again then.
Don't you think?
It could come up, but if it does, it will be quite interesting for them to test the same thing twice. Okay. Right. If they haven't given you a scope for your exam, then that's problematic.
Well,
right.
We've been tested on the whole book already. So.
Oh, you have been tested everything?
Yeah.
Okay, so then actually anything could come up then. All right. Okay, I'm just thinking they've tested the Bank Recon, but if they haven't tested anything else, the other stuff that they haven't tested will definitely come up.
They've tested.
But if they've tested everything, then everything could possibly come up.
I think the only chapter they didn't test was revenue from contracts with customers.
Okay, then revenue will definitely come up in your last assessment.
Yeah.
Okay, because they have to test everything at some point in time.
Yeah.
Okay. Alright, so that's theory. Right, just to build on that, the bank account must be compared to the bank statement. Okay, so remember, this is practical. Okay, it's something that we can do day to day even.
Yeah.
Alright, why? Individuals have bank accounts.
Yeah.
So do businesses.
Okay.
Okay, so do you check your bank accounts?
Yeah.
Why?
To make sure you've got what you're supposed to have, right?
Besides that, the bank could make mistakes.
Oh, okay.
Okay, so if there are errors that the bank has created, what must you do? You need to raise those errors with the bank.
Yeah.
Alright, so if we're looking at changing or adjusting, can I change or adjust the bank statement?
No.
I can't change the bank statement. Can I change the bank account?
Yeah, because isn't that your account?
Exactly. Okay, so I can change our records. Okay, so the business's records can be altered or changed.
Yeah.
The bank statement can't. You can't cross out and amend or change. Okay, so because you have that scenario, what do you do if there's an error on your side?
You alert the bank.
You would adjust. Okay, what happens if there's an error on their side?
You alert the bank, yeah.
You'd have to alert the bank, but you'd have to reconcile. Right, so you don't do both. You do one or the other. Okay, you never do both. It's either adjust or reconcile. Okay. Always consider whose records are correct. That's key. Right, if you know the bank is correct, then what do?
Reconcile.
I fix our accounts. Okay, the bank is correct. I don't need to reconcile.
Yeah.
Okay, what happens if our books are correct?
Reconcile.
Then we reconcile. Why? Because I can't fix the banks, but they need to do something. Does that make sense?
Yeah.
Okay, so always consider bank GL versus bank statement. That's what we're looking at. Alright, so I've asked 2 questions here. I want you to think of some examples. Can you think of any reconciling items? Okay, what is a reconciling item? It's an event or transaction that arises that is not reflected on the bank statement.
Last minute payment, isn't it?
Okay, last minute payments are outstanding deposits.
Yeah.
What else? Other events or transactions that will not reflect on the bank statement.
Don't know.
Outstanding payments. We can have outstanding deposits and we can have outstanding payments. And what else? Errors. Okay, that's the most obvious one. Yeah. Okay, so outstanding deposits, outstanding checks, or errors. Okay, so let's say, okay, how often do you get your bank statement?
Once a month.
Once a month. Okay, so bank statements get posted or emailed once a month.
Yeah.
Okay, what do businesses have to do? They need to check what happened over the month compared to what happened in the bank statement. Okay, and if there's discrepancies, they need to account for it.
Yeah.
Okay, and that's what the bank recon is looking at. Okay. Right, the next bit is adjusting entries. Okay, so that's the focus. What is adjusting entry? It's an event or transaction that arises in the bank's books, i.e. on the statement, but not in our records in the general ledger. So what examples can you think of?
If you've been paid by a receivable in cash but you haven't done the deposit yet.
Okay, so a direct deposit.
Yeah, direct deposit.
Alright, why? A direct deposit will go into the bank statement, but will you have record of it?
No.
No, you won't. What else?
Direct deposit.
Is your bank account free?
Yeah, bank interest, isn't it?
Bank charges?
Yeah, bank charges.
Okay, what happens with the bank charge?
Isn't it only given to you the next month or something?
Okay, where do you see the bank charge? On the bank statement. Yeah. Okay, so when do I record a transaction? Your basics. When is the transaction recorded? When it occurs. Yeah. Alright, so when do I record transactions? Only when they occur.
Yeah.
Right, so can I post bank charges in my books if I don't know what the bank charges are?
Of course not.
So when do I know what the bank charges are?
Only when the bank gives you the statement.
Only when the bank gives you the statement. So this is what? A source document.
Yeah.
Okay, it's a form of source document. Why? It's proof that something has happened.
Yeah.
Okay, can you record transactions you think you're going to receive?
No.
No, you can only record them once you've received them. Okay, once they've occurred. Okay, so if a client deposits money into your account, okay, where will you see that? In your books or the bank?
Your book. No, the bank. I mean.
You'd see it in the bank.
Yeah.
Okay, because it's a direct deposit. Yeah. Right, something else. What else? You said interest. Would interest reflect in the bank's books? Yes.
Yeah.
Why?
Because they're charging you.
The bank will either charge interest on your account or give you interest on your account, depending on what the balance is. Okay. What else could arise in the bank's books but not in the bank account? There's a lot more here than reconciling.
Yeah, I can't think of any more.
Okay, dishonor checks, unpaid checks, debit orders and stop orders. Right, so a debit order would come off your account.
Yeah.
Okay, but you won't have any proof of that debit order unless you've seen it in your bank statement. Okay, so those are all the different types of transactions that can occur. And obviously errors again. Alright, errors would be something that the bank has done that we haven't provided for. Okay. Alright, then the last bit is just the process. Alright, so how do we do the recon? Okay, we need to look at the bank statement. Can I change the bank statement?
No.
No, I can't. Okay, and that's why we start with that balance. Right, there are different ways of doing the bank recon. You can either start with the bank general ledger, you can go backwards.
Okay.
Right. I find the best way of doing it is to start with what you can't change.
Okay.
Because you can't change the bank statement balance. But what the bank gives you is your statement.
Okay.
Right. If you agree with the statement, great. If you don't agree with the statement, then you need to reconcile. Okay. You need to do the check. Okay, so this is where the checking comes into account, in terms of the workings. Right, number 2 is to compare the bank statement to the journals.
Yeah.
Right, we highlight separate items not appearing on the bank statement, and then we decide to either adjust or reconcile. Do we do both?
No.
No, it's one or the other.
Okay.
Right, and that's the note